Hello guys, welcome back. In this video we are taking a look at Abercrombie and Fitch, very well known US retailer that I'm pretty sure you can find in a lot of countries. And this one has gone down about 30% today. That's because of its reported earnings. Let's take a look at what happened here, why Abercrombie and Fitch crashed today. And you will see that Abercrombie's revenue rose 4% year over year to 813 million for its fiscal first quarter, which ended April 30. A 13% rise in the company's brand sales, partially offset by a 3% decline in its Hollister brand sales. It's the same company, really. Now, the revenue in Asia Pacific region was hit very hard, as you'll see here. So net sales fell 35% to 29.8 million. You can understand that the coronavirus-related lockdowns, pretty much the company has been in lockdowns for so much time now for no real reason. And this is why their net sales have fallen 35%. I mean, if people have to stay at their homes, you can understand that it's kind of impossible to buy stuff. And so there has been also a decline in Abercrombie's profitability. Like, of course, many other retailers that we have examined so far, pretty much everybody has suffered from inflationary pressures, higher freight and product costs. And so this contributed to a decline here in its gross margin. Now, Abercrombie generated an operating loss of 10 million compared to an operating profit of 57 million in the year ago quarter. So it's a significant loss here compared to what happened a year ago. The thing is, which is also interesting, its guidance, what's going to happen in the next few quarters. And for the next one, it looks like we're going to be seeing sales to be flat to up to 2% or flat to up 2% in fiscal 2022. So very marginal growth here in terms of revenue. Again, because of the issues we are having right now, it looks like 2022 is not going to be a great year. Down from a previous estimate of 2 to 4% sales growth. It wasn't very high to begin with, is the thing. They also lowered their operating margin target to 5 to 6%, down from 7 to 8. So yeah, there are some issues here with the company and higher costs. People are not buying that much. I mean, there's like Asia lockdowns and things of that sort. So you can understand that there's gonna be some headwinds for all these retailers. Now, when this happens, there's a very interesting opportunity here because the company has been down 61% and it looks like it may keep going down along with the rest of the stock market, which is absolutely crumbling these days. You're looking at a company that has had sort of like a run that's going up and down a lot. You will see that this is almost very cyclical here, going up and down quite a lot, multiple periods of time. And this is a company that requires the economy to be working like a clock in order to do well, as you can understand. And so when we're having a recession or when we're having a bearish market, this will actually potentially crash. Now, the thing is, it's down to $19 right now. So let's examine what the company is doing overall in terms of its financials, because if it goes down too much, it may be an interesting opportunity to buy and then wait for a reversal. So let's see what's going on here and whether the company is solvent enough for us to consider buying it. Their P ratio is at a very low level, 4.5, price to free cash flow at 5. These are numbers that I love to see. Of course, you would expect that from retailers to be low in terms of their multiples. But outstanding shares also going down. The company has been buying a lot of shares back. Also nice to see because you are getting more worth for your shares, the shares that you are already holding if the company is buying back shares from the market. Now, it looks like the company may have quite a few total liabilities compared to the free cash flow that they are generating. We're going to examine that in the financial statements. But take a look at this 5-year revenue growth. It's basically flat for the most part. That's in 5 years. And the net income growth has been increasing along with the free cash flow growth, which has remained relatively steady here. That's an interesting thing to notice as well. Net income increasing, but cash flows remaining steady. Now, the total equity growth has also been going down, and that's not a great thing to see, really, for a company that is having declining revenues, or at least steady, very steady revenues. And it looks like they're going down in the next year or so. Now, the debt to equity ratio is 1.21, so it's probably relatively okay. It is a little bit elevated. Would like it to be at a much lower level, and it looks like it got elevated very quickly in the last pandemic years. Return on equity has been 29. It looks like the company got some debt over here. Net income margin suppressed, and they're looking to be more suppressed, as we just read from the article. Now, let's take a look at what is going on with the financials, just to see the exact things that are happening here. 3.4 to 3.7 sales billion. That is, of course, pretty much steady here. It's almost identical, just a minus increase, just a minor increase. And 7 million here, and 74, 39, and 263 is what they did in fiscal year 2022, is what we're having here in terms of the income statement. And the balance sheet, as you'll see, it is going to be 1.2 to 800 million. So the company is actually losing money here, and that is interesting to see. It means that the company is effectively either getting more debt potentially, or just losing some of their assets, or just not increasing their assets compared to their liabilities, really. So that is what is happening right now. And you will see also that the retained earnings have been going marginally down here. So the company hasn't been able to keep what they are making in the last 5 years. It looks like they are basically steady here, not really making any extra money for their reserves, for their retained earnings here. But you will see what I mentioned earlier, the long-term debt getting increased here. So it's actually gone a little bit down in the last year or so, but still overall increasing massively from the last couple of years, as you'll see. This is what affected their debt, really, and their comparison to equity, the debt-to-equity ratio. So overall, you will see here that they have been having some assets like the PPE assets, property, plant, and equipment, which are non-current ones, and pretty much all the other things are steady, like some inventory, other current assets. Nothing to see here apart from the extra debt, really. But what about the cash flow statement? Now, the cash flow statement has been increasing through the years, but it's relatively balanced out. I mean, it's not increasing massively, just a little bit. And as you'll see here, the operating cash flow is also similar to the net income cash flow, which is normal and to be expected. And the capital expenditures here also normal as well, about 100 million every year. So the company has been investing mostly into this one, and just paying back some debt here, but still financing quite a lot from the previous years. 540 million is what they did last year in terms of extra debt. And the cash that they have is about 800 million right now, with free cash flow being 178 million to 180 million. So it's basically identical to what they have been doing in the previous years. Now, you will see a company that is not really growing here. This is the whole story. This is what we have been saying. And so in our projections, we have to be extremely careful here and be very, very low, go very, very low and very, very conservative with our projections. So I'm actually going to go -1 here. So I'm going to assume that the company is actually going to lose some revenue in the next few years, then 0 and then 1. So I'm going to be extremely conservative and basically point to a company that's potentially going to be steady in the next 5 years, and see what we can get out of this one. The net income margins have been relatively low here. Now, we know that they're going down from last year, which was a pretty good year for the company. So we're going to go 1, 2, and 3. Again, pretty low here. The free cash flow margin, we're probably going to use something that's pretty much sort of like a standard, 180, 90, and 100, because again, the company has been a little bit all over the place with what they're doing in terms of the free cash flow. Very cyclical here. And kind of the same thing with their net income, going up and down quite a lot. And so you cannot really deduce an exact percentage based on the previous years. It's not very steady. So we're going to go with something that's relatively normal, 80, 90, and 100. An annual return of 13, and pretty much let's see what the company is worth right now. So yeah, our current price is slightly elevated when you compare it to our medium estimates, but it's close. And it's only our high one that is actually green here, but pretty easy green to see here. And the low one is sitting at $7. It's much lower than the current price. So based on what I'm seeing here, I mean, I have already, I have used revenue growth numbers that have been very, very limited here. Whoops. So let's actually try 1, 2, and 3. I'm actually a little bit curious to see what we're getting out of this one. So yeah, if we are using slightly more revenue growth, then we're getting even our medium estimates to be a buy right now. So, but notice that it is a marginal buy, 19.2 compared to 19.0109. So this company is interesting because it has fallen off a cliff, but the problem here is that currently retailers are getting completely beaten down, and there are issues. There are like supplies issues. There are tons of issues that are currently happening with the economy. There is like inflation. So there may be potentially, you may be looking at these companies going down even lower potentially. So while it comes up as a green right now, even with relatively conservative estimates, I would probably hold off buying this one just to see where it will actually end after the whole market gets adjusted to new economic data and we eventually potentially have much less inflation. It may not be the best time to buy this one because it's marginally an opportunity. And the thing is, what I don't like is that it's very suppressed in terms of the revenues and margins. So I don't really like these kind of companies because they can easily grow negative, and then we are looking at a different story. It's a different thing than a company like Best Buy, for example, which is very, very cheap and pretty much great value, much better in terms of margins, revenues, income, and everything. This one is very marginal, so I kinda think I would avoid it for now and just wait for for the market to resolve its thing. And if the price is still there, and I think it's gonna be lower actually, then it may be an interesting buy. And so then I would actually look at this company, and I think it will happen. I think there's a very, very big chance that we're gonna be seeing much lower values for Abercrombie and Fitch, and then I could see myself adding a little bit to my portfolio. So thank you for watching this one, and I hope you enjoyed this video. Please remember to leave a like and subscribe. And also, you can always become a member of this tool by becoming a patron, and you can get unlimited access. You can find links in the description box below, or you can also, if you like, visit our Discord channel where we're discussing every day there. So very, very nice and interesting discussions. We'd love to have you there so that we can increase our circle. Because, yeah, I'm telling you, we are having some very nice discussions with our members, and it's nice to be around. We'd like to have you there. And thank you for watching this video again. I'll see you soon. Bye-bye.